Let's get another check on the markets. Higher today after the Fed minutes gave no reason to believe the central bank would become more hawkish. But our next guest warns the Fed is showing naivete in its inflation battle. First time we've used that word on Fast, I think, ever. Michael Contopoulos runs fixed income for Richard Bernstein Advisors. He is the former head of high yield strategy at Bank of America. I think that's when we talked last, Michael. Great to have you back. Welcome back to Fast Money.
Thanks, Michelle. How are you?
So the Fed is really behind. I mean, you think that that's basically what the Fed minutes show?
Yeah, I mean, listen, we all know that they're behind the curve, and I think what we're seeing, what we saw today, is that they still are just hoping that supply chain bottlenecks are going to relieve themselves. They still think there's some degree of transitory to the inflation story, and they haven't really woken up to the idea that maybe there's a secular shift going on. Maybe globalization to deglobalization and over a decade of monetary and now fiscal stimulus has created a new paradigm of higher than average inflation. And I think they don't get it. I think they think they're going to hike 50 basis points a few times, and then that's going to be enough. And I just don't see that being the case.
Hey, Michael, it's Tim. Welcome back. When I hear you say, and I saw in your notes that you think credit right now is fine, and I'm going to listen to anybody on credit, it's you. But the things you're talking about in terms of the Fed and their need to be more aggressive and to basically cut growth out at the knees, at what point do you start getting worried about credit when growth is cut? In other words, what kind of growth headwinds will lead to some erosion here? And I know you can't pinpoint it to the data point or the date, but that has me concerned. And I have seen widening in high yield, although you don't sound concerned.
I'm not too concerned, Tim. I mean, let's look at the fundamentals. Leverage has collapsed. Interest coverage is at all-time high. So what's interest coverage? Interest coverage is the ability to pay the coupon on your debt through earnings. That's never been higher. What did corporate America do during the recession? Well, they termed out their debt and they locked in really low interest rates, just like home buyers did. And now their interest costs are so low, it's very easy to service those. You look at the amount of upgrades versus downgrades in high yield. Upgrades are outpacing downgrades. The default rate's virtually zero, and most of our models for default rates looking out over the next 6 months suggest they're going to continue to be zero. Cash on corporate balance sheets are near all-time highs, and now you're starting to see corporates in the last quarter spend that cash on CapEx. I think there's a lot of negativity, obviously, in the equity markets. Growth is clearly slowing, but it's not slow. And the Fed hiking, a few times isn't going to slow consumption when you look at consumer and corporate balance sheets as healthy as they are. So I just think that, certainly 2022 is not going to be a year for recession. Spreads have widened because of the increase in volatility. As a fixed income investor, you want certainty of coupon and ultimate payment of principal. And any increase in volatility would basically suggest that certainty is diminished. And that's what the widening has been about, not about fundamentals.
It's Karen. Thanks for being on. Let me ask you, these minutes that they seem, I don't know, May 4th or so, it seems like actually a lot's happened in the 2.5 weeks since then, where not just Powell, but a number of Fed governors have been very hawkish. Do you think things are different there now than they were when these minutes were happening?
I don't think that much has honestly changed. They're trying to tighten financial conditions through rhetoric, through forward guidance. Powell, I'm sure, loves the idea that the 2-year is up a ton this year and that they might not have to hike as much as, they would otherwise have to if the markets weren't lower, if 2-year yields weren't higher. But, I don't think we're seeing consumption get reined in at all. So I think not that much has really changed over the last 2 weeks. I think they're just trying to jawbone the markets a little bit and let them do their job for them. And, we'll see if that works. My suspicion is it won't, and they'll ultimately are going to have to actually hike higher than expected, or, increase the pace of QT, which I think is, of course, a secondary tool that they'll use.
So those two options, Michael, the equity markets, I don't want to say will likely, but we could see some more downside. Right now, you say that the Fed doesn't care if we see 30 to 40% downside on the NASDAQ, for instance. We're already down 26% this year. So that's another 14% or whatever on top of the decline that we've seen already. That's what your firm is seeing.
Yeah, I mean, Michelle, listen, I always get asked, isn't the Fed put still in play? Look at Q4 2018, where they backtracked. My answer has been the Fed doesn't really care about equity markets today. particularly when you consider that the majority of the downturn has been in what we think are bubble assets, long duration assets, spec tech and high valuation tech in general. And do you think the Fed really cares if those things go down that much? Not when they're fighting inflation. The difference between today and 2018 is they weren't really fighting anything. They had no battle. They just wanted to bring up the Fed funds rate as high as they could without really tipping anything out of balance. And when the market said mercy, they went and they stopped. This go around, they actually have something to fight. Now, I think they're naive in thinking they're able to fight it with a few 50 basis point hikes and then be done. But they're fighting inflation, and ultimately that means they're going to have to go higher. And equities going down is not going to deter them from that. Credit might, but not equities.
Michael, thank you. It's Melissa, by the way. But I'm so glad to see you. It's been so long. I'm going to let that go. We'll see you again soon.
Thanks, Melissa. Take care.
Mike Katopoulos. All right, Guy Adami, what do you think? I think that you like what he's saying.
I do. I do like what he's saying, because the Fed should never really be looking at the market, in my opinion. It's something I've been saying for a while, and they clearly did, specifically in 2018. I think they blinked for two reasons. They were getting browbeat by the administration at the time, and the market went down, Dan will tell you, 19.9% in 2.5 months. Of course, inflation wasn't a problem then, so they did what they needed to do, in their opinion. Now inflation is a problem. By the way, the inflation they were wishing for years. And I think, to his point, it's going to take a long time. This is not something that is, you can't defeat this overnight. And I don't think people fully understand how sticky this inflation problem is going to be. And if you want proof positive, just look at what's happened to the energy market over the last couple of weeks. Every opportunity to sell off, and it hasn't. And wait till China reopens. Watch how high crude goes.